In this episode of Investors and Operators, I am talking with Ray Tsao, who is the CEO of Probitas Partners, a global placement agent and advisory firm that has raised over 117 billion across 150 plus funds. Ray, I hope I didn't get that wrong. But today we are going to be talking about the tactics to win in raising money for emerging managers. So if you are an emerging manager, this is for you. We're going to talk about how do you maintain the momentum? How do you start the momentum? If you fumble along the way, how do you regain that momentum? This is for you. We're also going to talk about some fun personal stuff. But before getting to that, Ray, did I miss anything from the story?
No. This is great. Pleased to join you. Glad you're able to take a break from the character building side of not just the business, but the trials and tribulations of the races that you do. But it's a pleasure to join you.
Awesome. Well, let's dive straight into fundraising. We know it's a difficult market. Everybody knows that. But can you kind of walk us through what a successful fundraising process looks like for an emerging manager? And maybe let's just focus on someone who's raising fund one at 250 and walk us through how does that process go? Where are the typical hurdles in that process? What can the emerging manager do to help set them up better, maybe before it? Obviously, hiring a quality advisor who knows your industry and has successfully raised funds, yes, that's a given. But let's kind of talk about that. Let's start from square one. What does a successful fundraising process look like?
Sure. Look, I think it's not just placement or fundraising. I think it's every aspect of life, but preparation, drives opportunity, right? So as we think about it, how do you kind of frame kind of what you are? What is the value proposition to allocators from the get-go, right? That's a gestation process that, may take months or years to kind of appropriately figure out. I think the backdrop from where one comes, whether it's a spin out of an organization, whether it's more de novo, I think that all kind of feeds into kind of the storytelling aspect as you look to engage with folks. I guess maybe as we seek to define what is success, ultimately success is getting to the result that you strive to seek, right? If it is 250, it's getting to that 250. That drives a lot of credibility ultimately as you look to return to market with successor funds, that you kind of hit the bogey, kind of your first go round. But, the trials, the tests, I think a lot of it is tied to duration of the fundraise and how do you compress that duration? Because that comes at opportunity cost, a pretty marked one, right? There's the professional side. The longer you're fundraising, the more that kind of bleeds into the deals you need to do. These emerging managers are less likely to stand up multiple deal teams, right? In effect, the guy fundraising is also the guy leading the deals. And then two, of course, there's the personal opportunity cost, which is, look, fundraising for a lot of folks, you're looking at, unfortunately, hundreds of meetings, or at least, hundreds of meetings with discrete LPs. Each discrete LP maybe multiple meetings if you're able to convert them into being a capital partner. So look, that comes at an expense with family, which is obviously important for everybody, not just, me and you.
Yeah, let's dive into preparation more because on the surface, it seems obvious. These people who are raising funds have gotten to where they're at because they do prepare and they do a lot of other things right in their career. But what do you find people underestimate about the preparation that is needed for a fundraise?
Yeah, I think maybe a few things, right? One is, you need to think about, it's not necessarily a quid pro quo, but, what is kind of the catalyst to drive each conversation forward, right? And, if you are spinning out of a branded private equity shop with legal attribution, it's going to be a very different story if the backdrop's a little more muddled. So, as I think about it, how do you kind of carry each conversation to the next natural step, right? It may be something, pre-fund, if you're looking to be an independent sponsor prior to launching commingled vehicle, you may have, a deal on offer that you want to socialize with folks that are not just looking to back you for that specific deal, but ultimately for a fund. So you don't let that, that deal go to waste, right? you need to be careful again, just as around opportunity costs. You don't want to socialize it with so many people that it bleeds into, what you need to do. But that's an opportunity to kind of go to the next stepping stone with each discrete investor. I think too, maybe one mistake is um, naturally you want to punch up and associate yourselves with folks that have successfully raised, but you need to be different in this market. I think that's probably the biggest mistake. So what are the points that drive some sort of response or perceived differentiation? The good news with emerging managers is people will generally respect what is often the case. It may be relative youth, the hunger, the energy, the alignment, right? There are no contingency plans, right? It's existential. So people understand that. But I think tying that out with the strategy side of things, why is this ultimately accretive to their portfolio? Or does it add diversification? That's something they seek. Is it sector specific? What asset class, just given there's an ebb and flow as far as, private equity buyout is generally in vogue all the time. But we see ebb and flow with certain strategies that are maybe tied to base rates or things in that vein, or even more political in nature, right? I mean, depending who gets elected, that may have an impact for certain asset classes or certain strategies.
What have you found that um, what have you found in the maybe the earliest phases of the fundraise are the most common missteps or things that uh, maybe even just expectations, like you were
Yep.
mentioning family and all the other aspects that are part of the lives. Like, what are some of the expectations that need to be set for the team that is fundraising and also like the families that are supporting them?
Yeah, look, one, I mean, it is onerous, right? And one thing I just keep in mind is it's no different than anything on the personal side, which is first impressions really matter, right? So ideally, you're able to mitigate subsequent costs on time and attention with appropriate kind of investment on the front end. So what does that mean? That means that, one doesn't need to do meetings for meeting's sake until you feel that you're appropriately calibrated to solve for what people are looking for, right? Why, look, there's going to be those LPs that want to be early, that want to engage, even something more conversational in orientation because they want that early look. But for the most part, look, people are looking for someone that's the complete package, right? So are you investing to make sure everything checks the box? If you're an emerging manager, do you need to have a full-time CFO out of the gates? No, right? I mean, that can be something that, comes concurrent with the final close or even deferred, you know, when the capital investment makes sense. But what do people need? They need to make sure that you're going to check the box on the ODD side, that you're effectively institutional, if you will, from a marketing perspective, right? It's less about the PPM, which is more of a legal doc these days, but is the investor deck truly differentiated? Does it look professional? But more importantly, does it espouse, the types of, deals in your specific strategy? And why is it advantaged versus the established GPs that are also a dime a dozen, if you will? So that front end investment is everything. I think the other piece, which is effectively the overlay for everything you do in private markets is alignment, right? And it can be perceived or real. How are you aligned with your capital partners as you go to market? The most simplistic way to look at it is a form of economics and the GP commit, but it goes much broader than that, right? I mean, I think if you're able to forge something strategic in orientation, if you're a thought partner for your limited partners, that becomes much more powerful than just asking them for dollars. So I don't know if that was the right way to answer, Jordan, but I
Yeah,
mean, a
no,
lot of
and
layers.
I love to go into what makes a what are the components of a good story for emerging managers and what are the bad stories? Like, what are the ones where like you should not raise a fund right now. You
Yeah.
don't have a story that can win. So let's dive in. What are the stories that can win in fundraising for emerging managers? What does that look like?
Yeah. Well, I love how you use the word story, right? Because I mean, I effectively think, my colleagues and I are in a role where we're storytellers, right? But it's data-driven storytelling. So we can serve as best as we can that storytelling side, but we need the data. So I guess, to answer you pointedly, what's the data, right? The data is a function of pedigree and track record. In effect, is the espoused strategy that they're looking to do really, not just balanced, but justified with their body of work? And is it a body of work that's crystallized in something that's, legally attributable, right? Can they actually send across a, Excel sheet that demonstrates, or better yet, a fully fledged, legally approved, investor presentation that represents their track record? Tied to that is team, right? Because, you'll be able to, uh,
Let's talk a little, rewind on the first point. So for track record, I'm just making a complete argument here, or a throwing stuff up against the wall, see what sticks here. But do should all decks just lead with here's our track record? Okay, cool, check. Now we'll talk about the rest of the stuff. Or do people who have the track record at the back, is there something to hide?
yeah, I think it's important to get it out of the way. I mean, to your point, right? I mean, in a tough market where people are all top quartile, there's going to be invariably some way to cut the data, and some of it is fair, right? And we see this commonly. The folks that did upstream and that didn't work out for them in the past 3 years, it's probably worked out splendidly. They've pro forma their returns to exclude it. I mean, it can be any number of reasons. It could be even healthcare, right? We've seen some generalists, cut out healthcare because it's turned out poorly for them. Um, Look, we think one has to own the track record up front, and you need to provide the line by line in the back, because otherwise that just invites, probably some fair amount of skepticism. But I think it does beg the question is, some folks are able to raise successfully without legal attribution. And, there's ways to kind of work around it via referencing and things in that vein. Obviously sometimes things are public and people can back into the attribution quite easily. A number of firms folks are spinning out to just do not, there's no precedent to providing legal attribution. And yet these emerging managers have successfully raised. They work through it. Oftentimes people in my seat will put together kind of third-party referencing reports, right? Thinks of the likes of the Korn Ferry or guys in that vein that will, in effect, do reference packages at arm's length for these GPs. I mean, that can be a way to bridge the gap. But naturally, there's going to be folks that will never be comfortable with a manager unless they have a legally attributable track record. And candidly, even fund ones, are often a bridge too far. That's not the worst thing in the world, right? Because it allows you to kind of narrow down or winnow down the universe of folks you need to talk to, which ultimately spares you time and expense as well.
Let's keep on going with the other components of a good story. So first, track record, and then I think you were going into team.
Yeah, I mean, the team is the heart of it. And one could argue, just as if not more important, tied to that, of course, is continuity. I mean, there's no lack of, you mentioned kind of the stories that don't work. I mean, oftentimes the stories that don't work are team related, right? It can be the best, individual investors in the world, but they haven't worked together. Once they're put together, whether it's interpersonal or professional, things fall apart. There's no lack of examples there. So I think
How many,
continuity of team.
if you had to make a best guess about what percentage of first-time funds have a sole founder who spun out and then they're going to go hire the team versus, two people who worked at another fund, two or three people. What percentage of new funds have that true sole founder? And I'm talking about
Yeah.
buyout private equity.
Yeah. Look, I mean, I would say the vast majority of folks that ultimately want to raise a commingled fund, right? And they may do the independent sponsor route first, right? You're going to lack that continuity side, which is why in my seat, right, having a clean spin out or an embedded team that has done multiple deals together, and it may go beyond just, the partner level or capital P, lowercase p, depending on the setup. That's kind of the holy grail in my business when I think about partnering with emerging managers, at least for something that, has a better, chance or propensity to going straight to a commingled vehicle versus the deal by deal route, which, for what it's worth is not a glide path per se, because it's difficult in its own right, but it's increasingly common. I mean, I'm sure you've seen the same, right? There's no lack of very successful folks that have, done the independent sponsor journey and candidly are inclined to stay there as a function of, economic and, certain freedoms, when you're afforded the liberty of not having to go the commingled route.
It's interesting because we just came back from McGuire Woods Independent Sponsor Conference where we've done video for them for 3 years, done their websites, et cetera. And it's so interesting just to kind of see 3 years ago the people who are at the conference, and then now are like, no, I don't want to do a fund. Like, why would I do that? I'm living the life that I wanted to. Versus, and then you see equally um, successful people getting deals done and saying, no, this is my path because I want to win deals. I want to have a team because I don't want to be doing everything on all these deals. Like, I need a team. Otherwise, I'm just like, a one man band holding together 2 to 4 companies. And it's like, this is just as bad, just in a different way. um, it's interesting to see the evolution of the independent sponsor market and now the options that these managers have to stay down that route, or if they want to raise a fund, like there's some upside. There's a lot of upside. What Speaking of financial upside, just big picture, what is more financially rewarding in 5 or 10 years? Is that the true driver of the decision for people to go funded versus fundless?
Well, I think there's more than that. And look, kudos to McGuire Woods, Christian, John, Rob, and the team there for really setting up something that's truly differentiated and, a service to the broader community, right? Even folks like me that now, for a couple of years, now also camp out there, can't partake in the conference, but, really excited to meet, the thoughtful folks that attend. I guess to answer you, firstly, look, I think it this doesn't apply to everyone, certainly, but there still is a bias really from a franchise, expansion, maybe team growth dynamic to go the commingled route to raise funds on a serial basis. That is generally still where people bias towards. There's a smaller cohort of independent sponsors just because the capital base is so dedicated and they're probably going to be, quite selective on the deal side, right? There's no onus to do a deal, so to speak. Where the independent sponsor, model works out beautifully for them. I mean, why is it economically perhaps more interesting? I mean, no cross carry collateralization, right? So you don't need to think about a European waterfall or anything in that vein. So you get your carry dollars soon. There's a rational argument to be made for super carry or premium economics, tied to a threshold. And naturally, as performance dictates, they may just outright get privileged economics. So a lot of benefits to the model. I think the beauty now is because the US is getting more mature here, you get to pick the path, right? Subject to what you want. The harder path probably is the fund side of things. At the same time, once you've put in the sweat equity, once you've built up a franchise and have, a series of commingled funds, it does feed upon itself as well, naturally commensurate with the performance you deliver for your LPs.
Let's talk about uh, more to the bad stories that and or bad storytelling. Like, what does bad storytelling look like for emerging managers? And that could be, the first set of meetings with LPs when you're like, all right, we got a ways to go here. What does that mean? What are the components of bad storytelling?
Yeah, I love the question. I mean, it's kind of shades of like Charlie Munger, right? I mean, he always inverts the problem, right? So, to your point, it's how do I not raise a fund, right? I mean, how do I not raise capital for a deal? Well, for one, I mean, let's say it's a fund. I mean, I would only start pitching the story when you formally launch, right? I would put forth a strategy that doesn't seem differentiated against other folks in market. I would lean on email outreach as opposed to calls and in-person meetings where you can solve for a human dynamic. I mean, these are all pretty easy answers. So, I mean, again, part of it is as simple as preparation. Two, look, I think mixed views, even internally here at Probitas, on how coachable folks are on kind of the selling side of it, right? It's not about how necessarily how personable people are, but there's a lot of read and react in this business, right? As folks ask questions and, every meeting won't go swimmingly, but, what's their base capability to be, not just reactive, but to sell the story, be convincing, be charismatic. I think it's hard to weight how important that is, but all I can tell you is it's very important, right? It's something we've kind of learned the hard way where one can have the best data and we think we can bring the storytelling. But at the end of the day, We win when principal to principal, when they forge that connectivity and forge that relationship. So there has to be a base level of charisma, the ability to sell, be convincing for them to carry the day. Because what I think we're trying to bridge is cap intro, which I think is a failed exercise. In the age where distribution is becoming increasingly commoditized, you can go on Preqin, you can go on any of these robocrawlers and start to get contact information for LPs. So it has to go more than cap intro. End of the day, who's really closing? We want to be at their side, but people are ultimately betting on the person across the table. That's the GP. We may be there taking notes, right? But the GP is the guy that cements the opportunity, cements the sale.
Um, how do you think about the timing? I mean, to what extent should emerging managers reach out to some of these, foreign LPs, maybe you're going to go to Tokyo for a day or two. Like, yes, they're not going to be here for fund one, but they need to see you now because when you go for two or three, it is worth that 4 day trip to, 4 day trip or 5 day trip to Hong Kong, Tokyo, Singapore. Should they plant those seeds early in fund one, even though they're not going to come around for fund two or fund three? If they should, when should they include that in their fundraise?
Yeah, look, I think it depends on the GP, right? Not to give you a very, canned response. I think expectation alignment with our clients is critically important because there are folks that are game for it. I think the notion that one should always go to geography and do as many meetings as possible, 5 or 6 in the day, I think we would politely generally push back on that. We generally see, some degrading, if you will, of, meeting performance after a set amount. Some GPs bring it every meeting, so that's probably not completely fair to say. But I think the relationship building component is really important, right? If you think of the average sales cycle, maybe that's a good kind of segue. I think in the best case, you're looking at 6 to 9 months, barring some sort of quid pro quo, some deal-centered dynamic that forces their hand to make a quicker decision. And then, on a longer timeline, a successful timeline, right? I mean, the sales cycle can be multi-year or multi-fund. So long as people are willing to invest, it can make sense. I would say if you're a fund one, scale is a big question, right? But I would really question kind of the merit of going to Asia or the Middle East. I think Europe, generally there's good catchment for folks coming here. Europe can make sense. I think the secular trend, I would argue, is as far as capital flows, I mean, they continue to focus towards the US as a function of outperformance, but also just de-risking, from a geopolitical perspective. I mean, the US continues to be top of mind for folks that are looking for, those answers on both fronts, geopolitical and performance.
Interesting. Yeah, it's I've talked to some people who said, we did a trip to Singapore, really interesting, but it's just hard to push it along. And, I did investment banking with Asia for 6 years, 2 months, 8 days. And selling a business to Asian buyers is a prolonged process for a variety of reasons. But it's interesting, like when and to what extent do you plant those seeds early? Because you can't just come back at fund three in a tight process. But I don't live and breathe the market. So let's talk about sector by sector and what do you think LPs are still truly interested in from a buyout perspective? If you're to look at industry by industry, what is kind of everyone's already done it. Let's like LPs are worn out from it, they're over allocated, or is that even the right way to approach it?
Yeah, no, I mean, you have to be glass half full in your business and in mine,
Yeah.
right? And I think we both are. So, I mean, I would say we're more than cautiously optimistic as we look ahead to 2025. I don't think it's tethered to rates or anything in that vein. I think it's just a function of, we do great things with great clients. So the onus is on us to find great clients, and there's always going to be product market fit for great clients, always. That is the true joy in private markets, which is the best is yet to come. And I believe it thoroughly. right? So, we're optimistic is the takeaway. I mean, naturally, tail does wag dog in our world, right? I mean, I may be thoroughly convinced by a specific opportunity, but I need to find, that fit
Yeah.
on the allocator side. So that is a reality. And we've learned, some painful lessons in that vein. So maybe on the buyout side, look broadly, I mean, you see this in the public markets as well, right? Um, there's always a flight to quality. So that's probably the first cut. Um, the second one is value over growth, if you will. I think that's why buyout is certainly more topical than growth in VC in many respects these days. And then if you go kind of a layer deeper, you think more about, old economy. I mean, superficially, the value, or at least the multiples one pays for these types of assets tend to be lower. I'm not here to argue risk, but at least optically, entry valuations are cheaper, and that tends to be more receptive. So industrials has been very topical, and continues to be, candidly. I think anything with a value orientation for healthcare certainly has been received quite nicely. I mean, physician practice management, perhaps less so. So there's probably been an orientation, away from services into perhaps pharma services or devices. So, even within these sectors, there's capital flows to kind of subsectors, if you will. And, while tech has been, left for dead, if you will, for a lot of our peers, um, it is actually getting some burn, right? As we talk to pretty thoughtful folks. Again, though, with a value orientation. Um, energy in that vein, right? I think energy is very topical. And it goes much broader than energy transition, right? Which candidly is a different thing is a rather difficult thing to sell these days because, there's no lack of energy transition funds. But I think people are seeing that, look, the transition, if you will, is going to take a lot more time. And even things like upstream, where returns have been outstanding the past few years, are now within the realm of possibility for some allocators you wouldn't have guessed.
Um, why do you do what you do? You've been doing this since 2009, and I think
Yeah,
you
it's
you transitioned into leadership of the firm in 2019. You've been doing this since 2009. So why do you do it?
yeah, it's I'd also ask you, why do you subject yourselves to the painful races that you do, right? I mean, there's a character.
Because that's the only time I can get I can get 16 hours of just alone time. That I don't have to watch the kids running around the house.
Yeah, I mean, there's a joy in the struggle too, right? I mean, at the heart of it. I mean, I think, you know, part of it is obviously my own team, right? A special group of folks, where there's great alignment on values, ethics, and culture. And then if you take it kind of one kind of concentric circle broader, right, that also ties to the clients that we work with, right? That's our first cut. And that's winnows down, a significant number of clients that we can take on, of course. I think, the art of kind of building something is really special. I mean, you've done the same. I mean, you bootstrapped your business. I had, I guess, the benefit of inheriting something, but, not without its warts. Everything's a lot harder than you think. Everything gets worse before it gets better, right? And, that's how it was in 2019, certainly. Paying pre-COVID earnings for a business is, maybe not the smartest either, but that was out of bounds or out of my control.
What's the story of what happened in 2019, or what's the story of the firm?
Yeah, look, I think just naturally, there's a conversation that helped precipitate kind of the next generation of leadership, right? So obviously it wasn't just me. There was a layer of, MDs, and, the previous owners were gracious enough to be very supportive, economically and obviously beyond that, as far as helping us, usher in just the roles and responsibilities and, drive that next leg forward. I think there's a lot of stuff that, this business evolves very quickly. Speaking to, GPs wanting to be different, I mean, we want to be different too. And I think the root issue that we had in 2019 is people didn't know how we were differentiated against other agents. And candidly, it took us probably north of 3 years to get that figured out. I think where we are today, I do feel like we are differentiated against our peers, and that allows us to win more, and that drives a pretty nice flywheel, right? And that means every day when I wake up, I try to bring it, or at least bring the energy,
Yeah.
bring it, the energy and bring an opinion, right? Which is what people look for. And there's a level of excitement there, and just building it with my colleagues, right? We're not an overly large organization. We're global in scope, right? We're a distributed sales organization with, obviously a lot of fixed costs when you look at the number of offices that we have. But that lends itself to a lot of, inputs globally with really thoughtful folks, GPs and LPs alike. And there's great joy in having the conversations with folks like this. Very smart people that, regular way I would never have the opportunity to speak to. So I think that's why. I mean, is it the best, from a, uh, the perspective of spending time with family? I mean, maybe not, but there's going to always be appropriate kind of harmony on the work-life front that we're going to espouse to everyone on the team here.
How do you think that you have grown as a leader and a manager maybe over the past 5 years? And I'm asking that because we're going through that next phase of from startup to scale up, and that is a whole different skill set. And we have found that the firm is growing, and we just keep on being put back into execution of projects. And here's a great test of the business where we went off to um, Asia. We dropped our kids off for 2 months with the grandparents in China, and then we went and picked them up for 3 weeks. And it was such a good test of the business to see what functions are doing great, good, average, and underperforming. Execution was actually doing really well. It was sales and marketing. It was like, oh, and guess whose responsibility that was? Me. Like, okay, we need to fill that gap. And so we're going through a transition on how to scale the business. And I noticed that I'm doing too much execution. My co-CEO and wife Jing is doing too much execution. So we have to learn how to manage, trust, and hire. But like, what have you found have been the biggest areas of growth for you as a CEO over the past 5 years?
Yeah, I mean, failing a lot. I mean, that's for sure. I mean, to a certain extent, felt like 2019 to 2022 was a lot of A/B testing, right? In many respects, that resulted in a lot of failure. I think
In what way?
one is, what's that?
Yeah, in what way?
Well, I think, we're in a pretty results-oriented business, right? I mean, it's pretty binary. You either get the commitment or you don't. You either win the client you want to win or you don't. Um, so I think part of it is, you can't only be stoked about the results, but rather the process of doing it, right? Because the outcome in placement or in fundraising is, generally pretty uncertain. Um, that ties to, the duration of the sale, the relationships it takes, and obviously data sometimes that's beyond your control. It's at the GP's control also, but sometimes, again, beyond them as well, if there's some sort of black swan event like COVID in particular. So I think, one, you have to enjoy what you're getting out of it. You need a team that's really has a growth orientation. I think one,
What does that mean?
misnomer, well, it's it's pretty interesting, right? I think the default, if I'm in a GP seat, I'm always going to bias to age, right? Because age, the optics are, you'll have deeper relationships. I think that's probably to a certain extent true on the investment side, just more reps and things in that vein. But I mean, you need to hustle in placement. I mean, you're on the road. I mean, a lot of folks default to email. We're trying to shortcut the process. I mean, calls certainly help, but there's no shortcut to being in person. And, there's the opportunity set generally is not going to be on the coasts. It's not New York, Boston, San Francisco. I mean, that's a knife fight for dollars, right? And we've just found that it's generally the longer tail of folks where you do benefit from the relationship side, and there's just no shortcuts there. And then if you think about it from a process standpoint, yes, there'll be those commitments where you go in at the CIO level, right? Come in at the top. No different than how Asia was, a decade ago, to be honest. But increasingly, there's a process to each LP. And yes, you have to pick your champion, right? Who's going to champion and be interested in the opportunity. But that can run a gamut as far as roles and responsibilities. Yes, it could be the head of private equity if you're looking at buyout. It could be the head of North American buyout. It could be, the associate who's tasked to kind of originate the opportunity. So knowing the individual personalities for each allocator is very important. And again, you only do that when you're out there in person and you're hustling. You're not relying on a maybe a stale relationship that granted you've known for 10 plus years. So I would say, as we think about, who are we looking to fill the role and the seat? I mean, it's those that have a lot of hunger, a growth orientation, but then also increasingly there's a blurring of roles, right? Like, I don't think we need to have a distinct sales and project management function. I think the advisory piece has always been underappreciated in placement. I mean, at the end of the day, advisory, I think one should overweight that value. I mean, the beauty of placement is we should have a leg up on in-house folks that only raise a single fund family on a serial basis. Because yes, we're going to have a lot of focus, but we're going to have multiple touch points across the organization, across all of private markets, right? Be it private equity, private credit, real assets, and the sub, asset classes within each, growth, buyout, VC, real estate, infra, natural resources, energy, things in that vein that really lend for very, robust conversations that happen on a regular basis. So look, hiring for that is challenging, right? You need people that are willing to kind of take up that mantle. But there's a joy in that.
Yeah, I think that's really interesting because you can hire somebody who is technically proficient at the skill, running a process or telling the story. But there's also the component of culture fit for the size and shape of the organization and the stage of the organization. Because what you were mentioning, blurring the lines, like some people are truly not a fit for that stage of a business. And some people love it. Some people, we have one of our colleagues where loves execution, loves rebuilding our project management tool, loves thinking through our branding, and hey, can I help out on sales like that? And that's a growth oriented mindset. And then as a leader, how do you know when to reel that in to say, you are capable of doing all of this, but I really need you to develop the skill of this and the experience of this, because that is what you're going to need when you go to the next stage of us as a company. And I've noticed that for Jing and I as co-CEOs, and now we have 10 people on the team. It was just one person, then it was two, and then now we're 10, and we have 15 to 20 active projects at a given time. And now I have to stop blurring the lines. Like, I need to do my job. And
Yeah.
my job is not playing whack-a-mole, which got us here. Now it's focus.
Yeah, I mean, that makes a ton of sense, right? I mean, there's also, I mean, we could really go down the rabbit hole, but I mean, there is a lot of importance for you doing all those hard things along the way, right? I mean, again, it goes back to the racing side of things. Like grit is a really important component. You know, my business is cyclical in nature at the end of the day as well. There's going to be ebb and flow as far as, fundraising in general and for specific asset classes. You need folks that can kind of ride it out, right? And then tied to that, look, I mean, you need the right alignment across the team and you need empathy, right? I mean, you need folks that have empathy, not just internally, but externally. I mean, I think the funny thing is, there's most people, they don't want to read our emails. They don't want to read our stuff, right? For a lack of word, for lack of a better word, right? So once you realize that, you start to qualify, the importance of everything, that we do. Why is it interesting to them? Is it fun? Is it educational? Is it exciting for them to engage? Are you better served seeing them in person? I
Yeah.
think what is the service that we provide to them? It may be as simple as information.
So talk more about grit and maybe a particularly difficult time that you've experienced, whether it's with the business, the team, or personally, or going between it. Like, what are some really difficult times in your life that you've been through, and like how did you get through that?
Look, I think I'm like you in many respects. I like the struggle. I used to have more times for races and things in that vein, but my wife and I do a lot of stuff in outdoors and look forward to politely encouraging our kids to doing the same, right? And it ties to grit. Look, I think for us, any type of boutique, right? And this is why I think placement agents kind of run in cycles, if you will, because it's so hard. And for us, we try to lead from the front. What does that mean, right? We want to be on the front lines advising our clients. And this applies not just to me, but my other, senior colleagues and candidly the entire team. We want to be advising clients. We want to be meeting with LPs. We want to, block and tackle from the execution side. We want to think about new kind of strategy lines, if you will, within reason. And at the same time, this whole kind of notion of service excellence, right, embodies us through and through. Obviously counseling LPs, we need to have conviction that we're actually being additive, right? If we're bridging the asset liability gap at a pension, and we should take pride in that, right? That we believe that we're going to deliver alpha for their portfolio. So, I think what makes that, challenging, of course, is just the realities that encroach on the day to day, right? Because I think many folks in my seat, all they're focused on is originating new business. And that's a little bit of a bait and switch, right? Because the person originating the business is not the one there in the mines, side by side. That's why I think placement is not scalable, right? It's not scalable in the sense that the investment side is. There's going to be a dilution as far as effort, alignment, as one scales beyond, a certain threshold. That's why focus of mandates is so important. After a certain point, how can you credibly represent that you have conviction? You can be a little cute around the margin around geography and asset class and things like that. But end of the day, if you have 30 buyout mandates, and not to throw stones at the banks, right? Because the banks, that's their job, right? But then as a salesperson, how do you actually credibly put your personal kind of reputation behind more than two or three of them? You can't. So it becomes, a menu. And the first two or three will win and the balance will lose. Or at least, if they get done, will be a slower velocity than they could have in optimal scenario could have delivered. So what we want to do is drive the best client service. And ultimately, look, we'll always have a knife fight with those that are perceived to be bigger. I would argue not better, but certainly bigger than us. But we're happy to fight that fight predicated on our ability to provide the best, service to our clients.
Um, what advice would you give yourself maybe 15, 20 years ago if you were starting your career?
Well, probably go to the investment side. Um, Look, I would say there's no shortcuts in life. Like I've enjoyed it through and through.
Well, but
Uh,
let's go into that because there's something there in terms of going to the investment side. There's something there like the grass is always greener psychology, and that brings up something you were kind of talking about before we started recording of like, we're going through the growth of our business and thinking about comparison. I'm like, I'm 40 years old. Like, I should have figured this crap out. Well, like, what's wrong? Like, we should be 10 times larger. And it makes us kind of think about, I think comparison, some say it's the thief of joy, but
yeah,
also I think comparison can be very useful. It helps us grow.
yeah,
So what when you're saying go on I know you're saying it in a joking way, but I think there is a deeper thing there. Like, how do we stay happy in our career and our lives?
yeah, yeah. Yeah, I was definitely being flippant. But look, I think what it boils down to is, there's a recurring nature to the investment side, right? Because you're backed, again, on a serial basis at a fund level. And that's what I want to solve for. You know, I say this humbly, right? No one grows up saying they want to be a placement agent. It just kind of happens. And that's what happened for me. And I find joy in it, And what I want to set up is something recurring in nature where I'm working with folks that I love working with on a serial basis.
Hmm.
And that sparks joy, right? As I think about it, because they're people I know, they're people I trust. And, my team are motivated to deliver the best possible outcome. So, how can we do something recurring, even if, economically, structurally, it's not, necessarily something that is, on an annual basis. But then also just the idea of like counseling folks, right? Can we be a thought partner? And not to be too grandiose about it, or, there shouldn't be, you know, uh, but
No, I know exactly where you're going at. I love the calls when we're talking about something that has nothing to do with marketing. And like that's how we got into the recruiting business line that we started. It was
yeah,
just talking strategically about the growth of the firm. And then the clients are like, well, can you do this for us? It's like, well, I've placed 300 veterans at jobs. Like, maybe I could place 8 consultants and junior consultants from Bain, BCG, McKinsey. Like, okay, we'll figure it out.
Yeah.
And
I
it
mean,
was,
that's
but it came from like just having that consultative mindset and just honestly, I just freaking love having strategic discussions.
yeah.
Yes, I love the tactical. How do you get 500 likes on a LinkedIn post? I love that stuff. But I also love the strategic, like, are we even building this thing in the right direction?
Yeah. Yeah, I'm right there with you, man. I mean, I tell you, that's the most exciting part of this business. I mean, are you really advisor, knowing that at some point they may outgrow you, if you will, but you've done what you could through and through. I mean, look, that's what, really kind of when you distill it to the heart of it is what we seek to do as a firm. Um, I think really can you just build something that hopefully survives you as well, right? As you think about it. I mean, you're kind of setting something up for the long term. I mean, that's very exciting, right? You're providing a service to the broader community, right? And some of it is reactive, right? But it happens, with great intent. I think about us, we started working with independent sponsors or, direct deals, if you will, as a function of trying to provide the best service to our fund clients. As they spun out from a group, they would maybe do one or two funds and then launch a commingled fundraise. I mean, that's why we started up the direct business, a little more than a year ago. The same goes with, syndicating co-invest and things in that vein. Obviously that goes back farther, but that was a reaction. And then ultimately, working with our, clients, in the interim between fundraisers. I mean, that really sprang up in 2020, right? We wrap up a fundraise. Well, in this interim period, I still want to be cultivating relationships. What can you do for me, like in this interim period? Well, we can set up a business kind of around it, right? Obviously, with a look forward from an economic basis into the next fund, but we both win, right? I mean, we both make effectively a calculated bet on each other. So look, I think that point you make is spot on, right? You can react to where there's like a market need, and it's because of probably people think that you do a good job in other aspects or other areas of the business.
And I think that one of the key words there is need. And like you want to do something where you are needed. And I think we need that in all aspects of life where we don't want to be the commodity. And I think that's one of the things I've has kept me going is that we have something very specific that we do. We finally built a brand and that we are needed to tell that story of the brand. And that's what's fulfilling because then it builds a meaningful relationship. And that's the cornerstone of everything that we do. It goes back to our name for our company, 51 Labs, meaning 5149 of always give more than you receive and taking the long-term view on everything. And it's like a reminder to not be transactional. Um, well, we have covered a lot of ground in this. And wonder if you have any parting thoughts or parting words about maybe some a favorite book, a favorite quote, or something that kind of keeps you going.
Yeah, look, I think anything, my wife and I do a lot of rock climbing, right? So anything that ties to grit is super helpful. But I mean, her favorite quote is, I'm going to butcher this, it's basically getting to the top is optional, but getting back down is mandatory, right? So I always love that quote, right? I mean, how does it tie to my business? Well, I think it depends, but look, it's always driving to the best outcome, but solving for kind of a floor from a risk standpoint. And also, as we think about engaging with allocators, same deal, right? We want to show them that will be accretive to the portfolio, something that we can be proud of, that we placed and kind of did business with through and through. And then just on a personal front, we got kids to come home to, man. So it's always front of mind.
There we go. Alrighty. Well, I appreciate this and looking forward to getting this out there. Thanks so much for taking the time to do it.
Thanks so much, Jordan. Take care now.